Welcome back to XRP Economic Radar, your trusted source for the latest XRP news, Ripple developments, crypto regulations, and the biggest stories shaping the future of digital finance. Today we have a major story that is sending shockwaves through both Wall Street and the crypto industry. Ripple CEO Garlinghouse has publicly fired back at JPMorgan CEO Jamie Dimon during a heated appearance on Fox Business, accusing the banking giant's leader of either completely misunderstanding the Clarity Act or intentionally spreading misinformation about it. The comments have ignited a fresh debate about who really benefits from crypto regulation and who stands to lose if digital assets finally receive clear legal treatment in the United States. As investors watch XRP price action closely and lawmakers continue debating the future of crypto regulation, this confrontation between two of the most influential figures in finance could have consequences that extend far beyond headlines. Today we're breaking down exactly what happened, what Garlinghouse said, why Dimon is opposing the legislation, and what it all means for XRP holders moving forward. The clash began when Garlinghouse appeared on Fox Business and addressed recent comments made by Jamie Dimon regarding the Clarity Act. According to Garlinghouse, Dimon's criticism of the proposed legislation simply does not match the actual contents of the bill. Garlinghouse argued that there are only two possible explanations. Either Dimon genuinely does not understand what the legislation says, which Garlinghouse suggested would be troubling given his position as one of the most powerful banking executives in the world, or he understands it perfectly well and is deliberately presenting it inaccurately to influence public opinion and lawmakers. The Ripple CEO did not hold back. He claimed that portraying the bill as a threat to compliance standards is misleading and ultimately harmful to productive discussions about the future of financial innovation in the United States. The remarks instantly became one of the most talked about moments in crypto news, as many observers viewed Garlinghouse's comments as one of his strongest public criticisms of a traditional banking leader in recent memory. What makes this story particularly important is that Garlinghouse believes the real battle is not about compliance, anti-money laundering rules, or investor protection. Instead, he argues that the fight centers around competition. Ripple and many other crypto-native companies are developing payment technologies that challenge long-established financial systems. For decades, major banks like JPMorgan have generated enormous profits by controlling key parts of the global payments infrastructure. Ripple's technology, powered by XRP, was specifically designed to make cross-border payments faster, cheaper, and more efficient. If blockchain-based payment networks continue to gain adoption, some of the traditional revenue streams that large financial institutions rely upon could face increasing pressure. From Garlinghouse's perspective, opposition to crypto-friendly legislation may have less to do with protecting consumers and more to do with protecting existing business models that have remained highly profitable for years. As this debate unfolded, XRP itself was attracting attention in the market. The digital asset recorded gains overnight and continued showing resilience despite ongoing uncertainty surrounding crypto regulations in the United States. Investors have been watching XRP closely because regulatory clarity could dramatically impact future adoption. While short-term price movements often grab headlines, many analysts believe the larger story revolves around whether institutions will eventually gain confidence to enter the market once legal frameworks become more defined. XRP remains one of the largest cryptocurrencies in the world by market capitalization and continues to maintain a strong presence despite years of legal and regulatory challenges. For supporters of Ripple, the recent developments surrounding the Clarity Act represent a potential turning point that could influence not only XRP's future but the future of the broader digital asset industry as well. To understand why this argument matters so much, it is necessary to examine the Clarity Act itself. The legislation aims to create a clearer framework for regulating digital assets in the United States. One of its central goals is defining which government agency has authority over different types of crypto assets. Under the proposed system, decentralized digital assets that function more like commodities would generally fall under the oversight of the Commodity Futures Trading Commission, while other assets that meet specific criteria could remain under the jurisdiction of the Securities and Exchange Commission. For years, uncertainty regarding which regulator controls various crypto projects has created confusion throughout the industry. Many companies have argued that inconsistent enforcement actions and unclear rules have discouraged innovation and pushed businesses to operate outside the United States. Supporters of the Clarity Act believe the legislation could unlock significant opportunities for institutional investment. Many large financial firms have expressed interest in digital assets but remain cautious because of legal uncertainties. Without clear regulatory guidelines, institutions often face elevated risks when investing in or offering crypto-related products. The bill seeks to address those concerns by creating a more predictable environment. Advocates argue that a transparent framework would encourage responsible growth, attract capital, and help establish the United States as a leader in blockchain innovation. Critics, however, worry that some provisions could weaken oversight or create unintended consequences. This difference of opinion has fueled intense lobbying efforts from both the crypto industry and traditional financial institutions, making the legislative battle increasingly important as lawmakers move closer to key decisions. One element attracting particular attention is the possibility that major cryptocurrencies such as XRP and Solana could potentially receive commodity-like treatment under the proposed framework. Such a classification could provide substantial benefits by reducing uncertainty surrounding how these assets are regulated. For XRP holders, this possibility is especially significant given Ripple's long-running legal battles concerning the token's classification. Supporters argue that clear recognition of XRP's regulatory status would remove one of the largest obstacles preventing broader institutional participation. This prospect has generated considerable optimism among portions of the crypto community, although many observers caution that significant legislative hurdles remain before any final outcome is determined. Despite growing interest, the path forward for the Clarity Act remains uncertain. While the legislation has made progress through important stages of the legislative process, it still faces challenges before becoming law. Political realities, competing priorities, election year dynamics, and lobbying pressure all contribute to an unpredictable environment. Prediction markets and analysts have recently lowered expectations regarding the bill's chances of becoming law within the current timeline. That shift in sentiment has caught the attention of investors because it suggests growing concerns about whether lawmakers can reach consensus before political momentum changes. The outcome could influence investment decisions across the crypto industry for years to come. Returning to the Fox Business interview, Garlinghouse's strongest argument focused on what he views as a false narrative surrounding compliance standards. According to him, critics who claim the Clarity Act weakens oversight are overlooking the fact that the legislation actually establishes clearer responsibilities and expectations. He argued that regulatory clarity does not mean deregulation. Instead, it means creating understandable rules that businesses can follow. Garlinghouse believes uncertainty has been one of the industry's greatest challenges, and that replacing ambiguity with defined standards would strengthen compliance rather than weaken it. From his perspective, portraying the legislation as reckless or dangerous distracts from the broader objective of building a safer and more transparent market structure. Another major point raised by Garlinghouse concerns competition between traditional banks and emerging crypto services. He suggested that financial institutions may feel threatened by innovations that allow consumers to move value more efficiently. Stablecoins, blockchain payment systems, and decentralized financial products have introduced alternatives to services historically dominated by banks. Some crypto platforms now offer yields, transfer speeds, and accessibility features that appeal to consumers seeking different financial options. Garlinghouse argues that resistance from certain banking interests may reflect concerns about losing market share rather than genuine policy disagreements. Whether one agrees with that assessment or not, it highlights the increasingly competitive relationship between traditional finance and the crypto sector. Jamie Dimon has long been one of the most prominent skeptics of cryptocurrency. Over the years, he has repeatedly expressed concerns about digital assets and questioned their long-term value. Yet at the same time, JPMorgan has actively explored blockchain technology and developed its own digital infrastructure initiatives. This apparent contradiction has become a focal point for critics who argue that traditional financial institutions support blockchain innovation when they control it, but oppose decentralized alternatives that could challenge existing business models. Garlinghouse's recent comments tap directly into this debate, suggesting that opposition to certain crypto policies may be influenced by competitive interests rather than purely philosophical disagreements. Interestingly, JPMorgan itself has invested significant resources into blockchain development. The bank's digital initiatives demonstrate that large financial institutions recognize the transformative potential of distributed ledger technology. This reality makes the current conflict particularly fascinating. On one side, Ripple is advocating for open blockchain networks and broader digital asset adoption. On the other, JPMorgan is pursuing blockchain solutions within a more traditional financial framework. Both sides acknowledge that technology is changing finance, but they differ on how that future should be structured and regulated. As a result, the debate extends beyond one bill and touches on fundamental questions regarding the future architecture of global finance. For XRP investors, the most important takeaway may not be the personal dispute itself, but what the dispute reveals about broader industry trends. The fact that leaders from major financial institutions and crypto companies are publicly battling over legislation indicates how significant these regulatory decisions have become. Regulatory clarity could influence exchange listings, institutional participation, product development, and international competitiveness. The stakes are enormous, because the rules established today may shape the industry for decades. Whether investors are focused on XRP specifically, or the crypto market more generally, the legislative process deserves close attention. Looking ahead, analysts generally describe three potential scenarios. In the most optimistic outcome, the Clarity Act successfully advances through Congress and becomes law. Such a development could provide long-awaited certainty for investors, encourage institutional adoption, and potentially create favorable conditions for assets like XRP. Many supporters believe this scenario would represent a major victory for the crypto industry and could accelerate innovation within the United States. Increased confidence among investors and businesses could help attract capital that has remained on the sidelines due to regulatory concerns. A more moderate scenario involves continued delays in negotiations. Under this outcome, lawmakers would continue debating key provisions while stakeholders from both sides attempt to influence the final language. The result would be an extended period of uncertainty. Crypto companies would continue operating within an environment where important questions remain unanswered, while traditional financial institutions maintain many of their existing advantages. This scenario is viewed by many analysts as the most realistic possibility because legislative compromises often require lengthy discussions and political bargaining before consensus can be achieved. The final possibility is that the legislation ultimately fails. If that happens, many supporters fear the United States could lose further ground to countries that have already established clearer digital asset frameworks. Companies may continue expanding overseas, innovation could migrate elsewhere, and regulatory uncertainty would remain a defining feature of the American crypto landscape. Traditional financial institutions would likely retain stronger control over payment infrastructure, while blockchain-based alternatives face additional barriers to growth. For XRP holders and crypto advocates, this outcome would represent a significant disappointment and could delay broader adoption efforts for years. As this story continues developing, one figure remains especially important to watch: the market's evolving assessment of the bill's chances. Recent declines in prediction market odds suggest growing skepticism about legislative momentum. Whether those concerns prove justified remains to be seen, but they provide a real-time snapshot of how investors and observers are interpreting political developments. One thing is certain: the battle between Garlinghouse and Jamie Dimon has become much more than a war of words. It now represents a larger struggle over the future of financial innovation, regulatory authority, and the role that cryptocurrencies like XRP will play in the global economy. For now, all eyes remain on Washington, on the markets, and on the continuing clash between the old financial world and the new digital one. Stay tuned to XRP Economic Radar for all the latest XRP news, crypto updates, and market-moving developments as this major story continues to unfold.